Let's talk banking now. The first quarter Ernst & Young Banking Confidence Survey has just been released. Do we care if bankers are confident? Well, I think we should actually, because it's such a massive part of the South African economy, financial services that is. Let me read you the first paragraph of the survey. It says the survey found that confidence was softer in the retail segment, partly offset by slightly stronger confidence in investment banking. Overall banking confidence was marginally lower from fourth quarter levels, falling from 84 index points to 80 points currently, below its first quarter 2012 peak, but well ahead of the weak level experienced through 2010 and 2011. Let's get into more detail now with Emilio Pera, who is the lead financial services director at Ernst & Young. Emilio, thanks very much for joining us on Power Lunch today. So bankers not quite as effusive and as ebullient as they were previous quarter, but still they're fairly sunny about the future.
Absolutely, and as you mentioned in that first paragraph, there is a bit of a disconnect between retail banks and investment banks. But although investment banking confidence is slightly lower, it's still well above the long-term average, and it is still in a growing trend environment. So definitely not at a stage where the market is contracting as far as growth is concerned.
So where there is that discrepancy, let's separate the two and perhaps start off on the retail side of things first. I mean, we've got, first of all, a slowing or a reining in of credit that is being lent out to the markets, or tightening of that credit scenario, and that one of the factors that's seriously coming to bear on the banking sector as a whole and its confidence levels as a result.
Yes, and in particular the unsecured lending or unsecured market, we see a more pronounced tightening of the market, and also impairment levels have gone up. So some banks have to look at the extension of credit, and in the environment where the economy is growing quite slowly, the banks have to look at their overall risk portfolio.
Let's have a look at the single biggest concern faced by bank executives, not just in South Africa, Emilio, but around the world. And this is something that is slightly disturbing given the economic data we're getting out. You say that weak economic growth is the single biggest concern, and you add that South African banks are largely responding to the weak growth in the domestic market by increased focus on their Africa growth plan. So it's almost as though they're saying, well, South Africa's part of the international community, international growth is subdued, so we're going to go into an area that is doing extremely well, i.e. Africa.
If you consider South Africa in the context of the wider African continent, our growth, economic growth, is quite slow, and therefore, in looking at future sources of revenue, it is to look at those markets where we see much faster growth from an economic perspective, and all, especially our larger banks, have indicated that they are looking to either further grow their existing footprint where they have operations, or look for other opportunities. One specific example is Nigeria, where all our banks are looking to grow, and only Standard Bank has operation of any substance in that market, and it is the fastest growing and the largest economy after South Africa, in sub-Saharan Africa.
As we've got South African banks looking to enhance their African exposure, what does that do to your confidence levels? Because that's a scenario that stands in contrast to the global picture, where you've got global banks, as you say in your report, facing liquidity and capital shortages and more focused on rebuilding their capital reserves.
I think for the South African banking banks, it does provide opportunities where other global banks might be looking to pull out of markets where our banks are looking to grow into. I suppose it's as far as confidence levels, it's more the cost of looking at that growth, and we have seen an increase in overall costs, and although we haven't seen any specific acquisitions, obviously the banks are looking at where they want to grow their existing footprint. They have to invest in their existing operations outside of our borders, which increases the cost, and obviously the growth for the group as a whole would therefore be impacted.
Do you find that there's differing confidence levels between the so-called two-tier banking system in South Africa? I mean, I'm assuming there is a two-tiered banking system, i.e. the Big Four, which we know about, and then people like Capitec and African Bank Investments Limited, ABLE. Do you find that there's the ones in the Big Four are saying one thing and the ones in the other sector of the market are saying something else?
Given the size and prominence of the Big Four in our market, when we look at the results of the survey, we look at the market as a whole. So we only make a distinction between retail banks and investment banks. banks, but we don't necessarily go down and look at any discrepancies as far as that is concerned in the tier 1 and tier 2, as you correctly state.
What is an overarching concern, though, for banks, no matter which tier you're operating in, is that cost growth and the fact that it's accelerating. Now, you say that to a large extent it's to do with their expansion strategies and the kind of growth they're pursuing on the continent, but it's also as a result of rising impairment charges, and that playing a role. So that's got to raise a few red flags as well.
Absolutely, and the levels of impairments that we've seen in the last quarter is at the same levels where they were in the first half of 2011. So at that stage we saw some relief from the deep depression of the global credit crisis, but we have seen an increase in impairment levels back to that first half of 2011. So definitely a concern. I suppose if you also consider at the same time, it is a competitive environment where our banks have to operate. We look at innovation and new products being launched all the time, especially in the big four. And to some extent, it is to counter some of the unique solutions that we've seen in some of the tier 2 banks. And that costs money to develop and stay ahead of the market or catch up if you're falling slightly behind.
Emilio, you say that lending growth in the corporate segment was particularly weak. Now, the macroeconomic implications of that, I think, are quite profound. Or is it because the corporates are not going to the traditional banks in order to get their funding? They're going to other areas, more innovative funding solutions?
We've definitely seen, from a credit growth perspective, the corporate sector has been very slow in recovery over the last couple of years, and I fully agree with the point that you're making, that corporates are either holding on to their cash and therefore not looking for lending or going for alternative means of raising funds. What we have, however, seen is that the business and volumes from the trading activities, with the exception of structured finance and treasury, has picked up quite significantly. So that trading activity definitely seen a positive trend in the last quarter.